I'm introducing this now is maybe my chart of the year. I'm not there yet, but I'm getting there quick. What a stunning statement on a global trade war. This is U.S. customs collections, and boy, is it a trend on a log chart, and then it's not. In Jane Foley, it's out 5 standard deviations, and you know 3 is normal, 4 is financial, like LIBOR movements in 2007, and 5 is ugly. This inertial force, Jane, what does it do to U.S. dollar?
Well, I think really the question is, what is it doing to global growth? And I think we've seen this, first of all, in China, and then we've seen this spreading through to Germany, through to countries like South Korea that have open trade links, strong trade links with China. And we're seeing global growth slowing now. Of course, it isn't just because of the trade tensions that we've seen a slowdown in global growth, but that is a significant part. Now, interestingly, when we try and layer on the US dollar onto this, we've seen the dollar remain really very strong. And we've got to the situation, I think, where we don't necessarily see normal textbook economics working for the dollar. We don't see a more dovish Fed pushing the dollar down. What we see is a US dollar which is hugely dominant in the global payment system. We've seen the rise of demand for dollars grow with the growth of emerging markets, countries like India, for instance, needing to buy more oil or needing dollars to do that, for instance. And this just repeated in various other emerging market countries. And we see the dollar strong. And I think basically as long as we have headwinds in the global economy, headwinds suggesting that we are looking at more uncertainties, we're looking at slower global growth, then the dollar generally is going to remain quite firm because people around the globe need their dollars.